Good morning, Traderfirstyear here. I know it's been a while since I last posted a video. This is the first one in quite a while. So 9/15, 2020, it's a new options position, Strangles, puts and calls. Traders will be long Theta and short Gamma to take advantage of a fall in implied and realized volatility. Expected outperformance from 9/15 to 10/16. And again, you're taking advantage of a fall in realized volatility and overall market dispersion. If you want to avoid the small print, the condensed version of the trade is pretty straightforward. It is a short vol via short front dated options and a short gamma profile. Your end goal here is to make $2,000 over the course of the month. And there's about 31 days to expiration on these strangles that you'll be selling. Potential again is $2,000. You can have a specific target percentage gain that you're looking to make, so it may not be the full $2,000. And again, different gyrations can take place in the market. Overall exposure is about $178,000 for the month. If you're looking for additional ways to follow Traderfirstyear and additional analysis, there's a Discord that's been created. A lot of people have joined, and there's a lot of really good market discussion that takes place throughout the day while the market's going. And there's also a subreddit for Traderfirstyear that's been created where you can find the link and then click over to the Discord. So the volatility expectation, I expect the overall market to move less than 5% plus or minus during the month. VIX expectation is about 1.13% to 1.57%, which is 18 to 25. And it's plus or minus. And Volga, which is VVIX, is I think it's going to be about 5 to 7 points over the course of the month, which is plus or minus, up or down. The range on the S&P 500 via VIX is between 16 to 26 this month, going from September 15th all the way to October 15th. Full summary and rationale for the trade. The end of the quarter passive fund rebalancing along with slight or no substantial changes in market positioning will give the market a chance to remain relatively range bound during the month, starting 9/15, ending 10/16. This rebalancing post-quarter end will provide traders structural opportunities to profit from selling elevated convexity into the market via put right, call right strangles, which are 5% out of the money. Traders will assume the role of insurance companies for a week, selling premium, writing policies, and keeping the profit at the end of the week. So profit from it. Brief on trading suggestion. We will temporarily be in a period of reduced swings up and down, but there is a slight possibility of realized volatility rising into quadruple witching on Friday, September 18th. Following quadruple witching, the market will be free to move. This, along with extremely accommodative monetary policy, should lead to a substantial decline in realized volatility, which is supportive of a slow melt up in equity prices. The rationale for the trade. The market will remain relatively range bound this week. This will present traders with the perfect opportunity to profit from selling volatility back into the market. A low return environment and possible negative curve with the Federal Reserve balance sheet expansion as a useful backdrop invite investors to aggressively re-engage in seeking to exploit timely carry trades by selling volatility back into the market. The risk for the trade. The risk is any large increase in realized volatility which causes the equity market to move up or down greater than 5% to 7% in a single week. This would create substantial problems to the right or left side of a distribution curve. What we would like to happen is the movement of minus 4%, or sorry, a little bit under 4%, and greater than negative 4% for the full week, or a little bit less than negative 4% for the week. Naked options on level 3 is going to be required for any of the discount brokerages that you're using. So if you take a quick look at the indices that we're going to be trading here, we're looking at the SPY, the Qs, and the Dow. And what you see here is put and call. So you'll see and again, you're going to be collecting income here on each of those. So when you sell the puts, you're going to be collecting that amount. When you sell the calls, you're going to be collecting that amount. And if what you notice is that the strikes are set up 5% up from the previous day's close, and 5% down from the previous day's close. And then if you go over to the far right, you can also see the income that you're taking in, which you see is about $2,000. The total exposure is about $178,000, and the break-evens are also listed to the right. What people really want to know is the risk that they're taking when you're selling convexity or you're short. So what is the worst that could happen in a zombie apocalypse in 31 days, or a massive Federal Reserve balance sheet expansion and significant irrational exuberance? How much do you owe under a large move to the left side of the distribution curve, and how much do you owe under a large move to the right side of the distribution curve? And what would happen in a market meltdown or a market melt up? Selling Strangles, and how much would traders using level 3 puts rights owe? And these are pretty good questions because these actually answer all the risk that's involved. So when you look at the risk, what I did was I just put if the market like you just take a really large number, like if the market moved up 30% or the market moved down 30%. And then I reprice the options, and you could see what you would owe and what you'd have to cover. So it's a substantial amount for each of them. So when you look to the far right, that's kind of what it's telling you. That's the new options price if the market were to somehow randomly rally 30% over the course of the month, or were somehow to sell off 30% over the course of the month. The last screenshot though is extremely important though, because that has to do with realized volatility. And so there's been a spread between realized volatility and implied volatility, and realized volatility has yet to catch up with implied volatility. So there's been about a 5 or 6 basis point spread. So we see implied being the VIX at about 26 or 25, and that's been coming down. You've noticed realized volatility has been about 19 or 20. So the expectation with realized volatility is that spread is going to narrow, but realized volatility is likely to come down. So realized volatility will probably be, if the VIX is at 18, we're just going to take 6 away from it and say, closer to getting close to single digits, maybe 10 or 12 by October. And I think one of the interesting caveats this time around with the election coming up is that we haven't had an election where the Federal Reserve has been expanding its balance sheet into an election. So I think the fact that they're engaging in putting a substantial amount of negative convexity and negative gamma on their balance sheet, that's probably going to change the volatility that we would normally expect during an election season, even in an election as contentious as the one that we're having. So again, if you want more information and you want to follow more analysis from Traderfirstyear, you can follow me on StockTwits, you can follow me on Reddit, you can go to the subreddit, and you can go to the Discord. The Discord's a great place to go and enjoy very enlightening conversation about the market throughout the day, and it's just a lot of people's different opinions on what they're trading and how they view the market. So again, thanks for following, and thanks for listening. Much appreciated, and enjoy the month and enjoy the trade. Thanks a lot.